Some economists are raising red flags over the country's growing debt pile, which is expected to hit around 7.3 trillion pesos by the end of the year.
But the country's economic managers shrug off these concerns, and they say the economy is strong enough to manage these obligations. Shaila Francisco has the details.
The Philippines' outstanding debt is expected to breach the 8 trillion peso mark next year as the government ramps up spending on infrastructure. That's a 9% jump compared to the same period last year and a 2.7% expansion compared to May. The administration is also planning to borrow close to 2 trillion pesos in 2019. By the end of this year, the Budget Department expects outstanding debt to reach around 7.3 trillion pesos. Halfway through 2018, the country's outstanding fiscal obligations have already breached 7 trillion pesos. The weaker peso and the sale of retail treasury bonds are weighing on debt obligations. The numbers worry an economist we talked to. Bienvenido Oplas is especially concerned about the potential burden the debt will cause taxpayers.
I think it's a big concern, not so much for the present generation of taxpayers, but for the future generation of taxpayers. A public debt is not debt by politicians or the debt by Secretary Dominguez or Duterte. It's the debt by Filipino taxpayers. The best that can happen is that taxes will remain high. Okay, the worst that can happen is the tax will even go higher.
Oplas is urging the government to focus on paying dues instead of adding the burgeoning debt stock.
Ang ginasabi nila kasi but we need to spend more on public infrastructure. But we've had a lot of big infrastructure before that resorting to big borrowings.
But the Finance Department argues that the economy is resilient enough to pay off obligations.
We're paying down our borrowings steadily, which means we will have more money to invest in our people. That means we are able to pay our borrowings in a timely and consistent way. So nababayaran natin yung mga utang natin na over time, paunti ng paunti.
Last week, Budget Secretary Ben Jokno argued that it's better to focus on the size of debt compared to economic growth rather than the size of the debt itself. Currently, debt to GDP ratio stands at around 40%. The government is expecting to narrow that down to 38% by 2022. The economy grew 6.8% in June, below the government target of 7 to 8% annually. Still, it's among the fastest in Asia. Meanwhile, National Treasurer Rosalia De Leon and Finance Secretary Carlos Dominguez defended the need to borrow abroad and to offer bonds as part of the government's funding program.
We don't also want to crowd out the private sector because that would also, we have very limited liquidity also onshore. So we'll also have to be able to secure and diversify our funding sources.
Last year, we noticed that we had been absent from the samurai bond market for more than 8 years. So we decided that it is time to go back to that market. We also had the opportunity to flow $200 million more or less in renminbi. And this is the first time we floated it. And we thought that it would be best to have a presence in that market as well. In fact, our program forward is not to abandon foreign markets because it's very difficult to get back to them if we need to. So in the future, we will continue to borrow both in yen, in the Japanese market, as well as in the renminbi markets.
Currently, the government has a 65-35 borrowing mix in favor of local sources. The country's economic managers are targeting a 75-25 ratio for 2019 to 2022. Shaila Francisco, We Are One News.